Stop making these 5 mistakes that's making you a losing trader. If you're new here, my name is Mo, and I'm a full-time options trader and an educator who's helped close to 5,000 people become profitable traders. And in this video, I'm going to be exposing 5 charting mistakes that's causing people to lose money. Now, in my own journey, I went through these mistakes, and I've also noticed that the seasoned and new people made these charting mistakes before they became my student. After I reveal these terrible mistakes, I'm going to give you a clear action plan on what to do instead. Now, let's get started. Mistake one, using the wrong time frame when charting. So one of the biggest things I've seen with new traders, they're using a short time frame to chart stocks. Now the problem is when you're trading options, one of the things that you're fighting against is theta, which is the value of time. When you look at short time frames, especially charting, a lot of your levels aren't going to happen because you're not giving it enough time. So when you're looking to chart a specific stock, make sure you start the charting process from a larger time frame, but you use a short time frame for entry. Now we're going to go over a clear example that's going to help you differentiate between larger time frame and a smaller time frame. All right, so in this example, we're looking at the chart of NVIDIA, and what we're looking at right now is a 5-minute chart. So the first thing I do when I'm setting up my chart is pull the chart to a daily time frame. And now let's say you're objectively looking at this chart to see if you want to take calls or puts, meaning you're trying to see if you want to buy upside or downside. Now, when I look at this chart on a daily time frame, I get a bigger picture on what's happened in this level in the past. So as you guys can see here, we have, and I'm going to mark it so you guys can see it clearly. The last time, and this was in September, we bounced off of this level. Then around January 29th, we bounced again. And then around March 06, we bounced again. So this is a key level. Now, because this is a key level and it's on a daily time frame, it makes it more trusting. If you guys were looking at a 5-minute chart, this could easily break, but because it hasn't shown you historical data, but daily you have data all the way 6 months back on this level. So when I'm looking at charts, I'm always looking for a larger time frame. One of the biggest mistakes people are making, they're looking at 5-minute charts, and it's not only stressing them out because the candlesticks are very volatile, it's also making them indecisive because they don't know if they should be buying or selling. And eventually what that's going to do for you is it's going to burn you out, or you're going to force charts or patterns or trades that aren't there, or it's going to make you force the trades that aren't there. So this is probably one of the biggest mistake. Never look at a shorter time frame unless you're scalping or day trading. If you are especially a new trader, you should focus at swing trading, and for that I would always start the chart with a daily time frame. So that's your mistake number one. So the second trading mistake is a lot to do with mindset, but it impacts when you're charting, and that's having a bias. So a lot of people are great when the market is running up, but when the market starts pulling back, they have a hard time playing puts. So what they do is they try buying a dip. All right, so we're going to look at NVIDIA chart again, and this time we're going to look at a different time frame. So what a lot of people then do is, because this chart here looks like we're looking at an hourly chart frame, by the way, a lot of people, what they'll do is they're going to look at this as a dip buying. The problem here is, if we look at a larger time frame, there's nothing wrong with buying a dip, which we showed before. It's a daily chart frame. Just know where your stop is when it comes to your charts. Just because we've bounced off of this 3 times, like I showed previously, it doesn't mean it's going to happen again. And what a lot of people do is, if they have the bias, they're not going to even think that that's even a possibility. So always know on the chart, if you're getting in a trade and if it doesn't work out, where is your stop? And so that's where the bias comes in. And for some people, let's say they're shorting it, they might think that, you know what, they might look at a shorter time frame and might think that this is going to break. So Either one is not good. When you are charting, make sure you don't have a bias, and the only way you can do that is by setting levels in case you're wrong, and then you have a plan if things go wrong. So for instance, let's say if I'm someone who's going to buy calls here at the moment, Nvidia sitting at 114. Let's say in a what if scenario, if it breaks 114, 112 becomes your stop here. That's an objective way of taking this trade. A biased way of taking this trade is assuming that that won't even happen. So that's not even part of your plan. So what's going to happen is when it actually dips down, you're not going to know what to do, but just hope that it bounces back. All right, the third trading mistakes, I can almost guarantee anyone that starts new is almost always guilty of that. And that is loading your charts with a bunch of technical indicators. I'll show you and give you an example. So usually when I first started, what I would do is have MACD on and sorry, wrong indicator. So what I would do is I would have MACD on and then I would add RSI. And my thought process was the more indicators I add, the better of my success rate would be. So my idea was the more indicators I add, the more successful I would be. So I have now added MACD, RSI, then I would add moving averages. I'd add 9 and 20. And then this is what my ideal chart would look like. And what you're going to notice is there is way too much happening on the chart. And regardless of if all the indicators are telling you the same thing or if they're telling you different thing, what this will do is you're going to get an analysis paralysis, which is because there's too much and you can't make a decision. In trading, one of the best things you can do is keep your charts very simple so you can make the decision fast. Most people that become indecisive not only lose money, they also burn out very fast because they can't figure out what to do. And there's nothing worse than losing money than to lose mental capital as well. So these are probably the three mistakes that are the most common mistakes I've seen a lot of new people make, and a lot of people who've been trading for a couple of years and they are stuck in the bubble of making money or losing money and they can't get to that consistent level. If you're finding this content valuable, make sure you guys hit like. And if you want to see more content with no fluff and no BS, so you can be a better trader and attain the freedom you deserve, make sure you hit the subscribe button. All right, let's go to mistake number 4. So this charting mistake, ironically, is a mistake that has nothing to do with charting. A lot of technical chartists think charts are everything. I'm going to give you two things that are much, much bigger than the chart. Number one is news. If Trump today announces tariffs, it doesn't matter if you have a bull flag or if you have the best chart pattern that you've ever seen in your life. It doesn't matter. News will always trump charts. I've seen a lot of people just be so stubborn and not change because a chart's showing them a certain thing. The second thing where people think charts are everything and it doesn't work is the environment. If we are in a seasonally weak environment like we are in March, where there's usually a big pullback, I become extra careful and I'm not looking to take too many trades, regardless of how great the chart looks. And it's because the environment of the market is always bigger than what the actual chart looks. Remember, charts are showing you what's happened in the past, right? They're showing you historical data. It's not telling you what's going to happen in the future. I use chart as a supplement to other tools I'm using. I'm mostly a flow trader and I combine flow with my chart. And that usually gives me a very good success rate. And I also use a risk reward in charting, which brings me to the last and the worst mistake traders make, which is they don't know their risk and reward when they're looking at a chart. We're going to go back to NVIDIA and I'm going to show you exactly what people do when they enter a chart. And I'm going to tell you exactly what people are doing. All right, so when we look at this chart here, I'm going to clear all the indicators. We're back to NVIDIA. People will know. So let's just add some indicators and pretend we're taking a trade because I want to show you how bad this mistake is. So a lot of people will take a trade right here, and the idea is to enter, let's say here on the break of the moving average. So if 9 takes over 20, you're looking at an entry there. And when I say they don't look at the risk reward, what I mean by that is before you even enter the trade, does this trade meet your basic risk reward? Meaning, if this trade doesn't work out, are you going to lose more than you're going to make? So I'm going to give you an example. So if we're looking at this trade here, and let's say I'm deciding my entry here because of the moving average crossover. If this trade works out, let's say this is my reward, meaning that this is where the last pullback happened, and you're thinking it might happen again. But if this trade doesn't work out, we test all the way low of the day. Would you still take that trade? Sorry, low of the week. Would you still take that trade? Regardless of what the chart's telling you, the answer is no. So a lot of people are entering trades without knowing how much they're going to lose if they're wrong. All they're looking at is how much they're going to make if they're right. These are the 5 key mistakes that not only stop you from making more money, but they're also burning you out slowly, which is causing you to eventually either quit trading or do something reckless. So now that you've gone through the 5 terrible mistakes people make with charting, I am going to show you exactly what to do to never make these mistakes again and become a consistently profitable trader. I'm going to give you guys 3 action items that are going to help you avoid these mistakes forever and give you a clear and direct plan when you're charting for finding profitable traders. So let's get the charts added. So these 3 action plans are based on a simple principle called keep it super simple. The first thing I want you to do is anytime you're looking at a chart, always look at a longer time frame. Never look at a 5-minute time frame when you're looking at an overall trade. Once you go on a longer time frame, all your bias will go away because you're going to have a bigger picture. You're not going to worry about what's happening to the chart today or 5 minutes ago. It's going to give you months of data that's going to make sure all the bias is eliminated. The second key item, and this is important, is you always make sure that there's never more than 2 indicators on your chart. So for this example, we're going to use support and resistance and moving average, which is typically what I use. So 200-day moving average is what I use. Another one is 50-day, and then another one is 100. I use the one that's most relevant. In this situation, 200-day is the most relevant. So I'm going to use that as one of the key areas where we might reject. The second level I'm going to use is this level right here. This is where the chart has bounced multiple times like we talked before. And then I'm going to use this level here as a key level as well. The third and the final action step for you guys is you never ever take a trade without knowing the risk reward, meaning you should be able to look at the chart and tell if this trade is worth the risk reward or not. So for our example, we're going to calculate the risk reward on that trade. I always have my chart visually very appealing. So when I look at the chart, I know clearly what I'm going to do. So first thing first, if I'm looking at buying calls here, the green is my profit. This would be my entry, always yellow, and this would be my stop, always red. Now that we have here, we're using trading view, so I'm gonna scroll left here, click on long position because I'm thinking of taking a call here. I'm going to click and match all the lines. And essentially what this is telling you is my risk reward on this trade is 2.22. What that means is if I'm right on this trade, I'm going to make 2.22. If I'm wrong on the trade, I'm going to lose 1. If I took all my trades on 1 to 2 risk reward ratio, I only need a 50% success rate to be profitable. My ideal trade is always 1 to 3. But in this situation, this is also not a bad trade. And this is where you decide if you're going to take this trade or not. Inversely, I want to show you something. Imagine if you took the entry about here. And if I was to rearrange this, your risk reward now is 0.57, which is a negative risk reward. There is no way and there's no reason I would ever take a trade like this, because regardless of what you do, over time, you're going to lose money even if you had a success rate of 90%. I hope this helped you, and I would love to hear some comments once you try these 3 action items. Make sure you guys subscribe to this content. I'll be making a lot more videos in technical as well as mindset topics for option traders. Also, if you want, check out the link in the description for deeper insights delivered to your inbox. As always, have a great day.